Here's a question I don't think I hear enough when I meet people for the first time. Is there an ideal mix of accounts I should have when I enter retirement? Look, I get it. For decades, you've been told to max out your 401k, maybe open an IRA, save, save, save. But what if I told you that having all of your retirement savings in just one type of account might actually limit your options and potentially cost you tens of thousands of dollars in taxes over the course of your retirement? Hi, I'm Sam Rodriguez. I am a certified financial planner and I am the founder of Foundation Wealth Partners. And for more than 20 years, my mission has been to simplify the complicated parts of wealth building so that way you can make confident money decisions. If you want clear, jargon-free financial information that can help you make smarter decisions, make sure that you hit like and subscribe. It really helps the channel grow and it tells me that you want more videos that cut through the noise and give you practical strategies that you can actually use. Over the last 2 decades, I've seen this play out time and time again. When people arrive at retirement with substantial savings, sometimes millions, but it's all locked up in traditional 401ks or IRAs, they may think they're in great shape until the tax bills start rolling in. And here are the facts. Tax diversification can be a powerful tool that help minimize your taxes and maximize your income by giving you more control of your taxes in retirement. Yet it's something that I see very few people actually plan for. So in today's video, I'm going to walk you through the 3 core account types that I believe you should consider: traditional, Roth, and taxable, and why I think each one matters and what research tells us about the ideal mix. By the end, my hope is that you'll understand that you can plan ahead to develop a strategy that could give yourself more control over your taxes, your cash flow, and hopefully your lifestyle in retirement. But please be sure to always consult a tax professional or planner or estate attorney before implementing any of these strategies. Let's start with the basics, because before we talk about an ideal mix, we need to understand what we're mixing. There are 3 primary types of accounts I want you to think about: tax-deferred, tax-free, and taxable. Your tax-deferred accounts are your traditional 401ks, traditional IRAs, 403bs, basically any pre-tax savings accounts where you've got a tax deduction going in. So money grows tax deferred, which means you're not paying taxes along the way, but you will pay ordinary income tax when you take distributions in retirement. And here's the thing, these accounts can be incredibly valuable, but they come with strings attached. Once you hit age 73 or 75, if you were born in 1960 or later, the IRS mandates that you start taking what are called required minimum distributions, or RMDs. Whether you need the money or not, you're forced to take it out, and that withdrawal is fully taxable as ordinary income. So for a $1 million traditional IRA, that first RMD at age 73 could be about $38,000, and it only goes up from there. Your Roth accounts, Roth 401ks, and Roth IRAs work the opposite way. You do not get a tax deduction when you contribute money, but your money grows completely tax-free, and the withdrawals in retirement are tax-free. And there's no RMDs during your lifetime, which means you control when and if you take money out. This is what I call your freedom bucket. When you need to take out $10,000 for a big expense, but you're sitting right at the edge of a higher tax bracket, you can pull from your Roth without adding a single dollar to your taxable income. That kind of flexibility can be incredibly valuable. Finally, your taxable brokerage account. This is money you've already paid taxes on. You can add or withdraw at any time with no age restrictions, no IRS penalties, and no RMDs. If you hold investments for more than a year, the gains are taxed at favorable long-term capital gains rates, often 0, 15, or 20% depending on your income, not ordinary income rates. For your heirs, taxable accounts get a step up in cost basis at your death, which can wipe out decades of embedded gains, which can make it an efficient legacy planning tool. Each of these buckets does have trade-offs, and that's exactly why I think you want all 3. I don't think you're trying to pick a winner, you're just trying to build a system that gives you options. And like I said before, you should always consult a tax professional or estate attorney before implementing any of these strategies. Let me paint a picture for you. Imagine you're 65, you've just retired, and you have $1.5 million saved, but it's all in your traditional 401k. You think you've done everything right to build what you think will help you reach your financial goals. You've matched your contributions for 30 years. You're proud of that balance. But here's what can happen next. You claim Social Security. Maybe you have a pension. You may be feeling like you're in a pretty comfortable spot, right? Then age 73 rolls around, and now the IRS says you have to start taking out around $57,000 a year as your RMD. That's on top of your Social Security and on top of your pension. Suddenly, you could be pushed into the 22 or even 24% federal tax bracket. Now let's add state taxes if you're in California, New York, or another high tax state. You could be looking at a combined rate of 30% or more on every dollar you're forced to withdraw. And remember, you're not choosing to take this money out. The IRS is making you do it. But it can get worse. If your income crosses certain thresholds, 218,000 for married couples filing jointly in 2026, you're also hit with Medicare IRMA surcharges, meaning you're paying more for your Medicare Part B and Part D premiums. And if your combined income exceeds 44,000 as a couple, up to 85,000 of your Social Security benefits become taxable. This is what I call the tax trap. You may have saved diligently for decades, but because everything is in one bucket, you can be handing the IRS a lot more control of your retirement income than you may have planned for. You can't avoid the RMDs. You can't manage your tax bracket. This is where the IRS could have more control over your income than you do. Now contrast that with someone who has a balanced mix. Let's say they have 500,000 in traditional accounts, 500,000 in Roth, and 500,000 in a taxable brokerage account. When RMDs kick in, they're smaller because the traditional account balance is lower. If they need extra income, they can pull strategically from their Roth or taxable to stay in a lower tax bracket. If they want to do a Roth conversion in a low income year, they have the cash in their brokerage account to pay the taxes without touching their pre-tax retirement funds. They have more control, they have more choices, and that is the difference. Again, I always recommend that you consult with a tax professional before implementing any of these strategies. So what's the magic ratio? What should your ideal mix look like? Here's the honest answer. There isn't a universal formula, but research from firms like Edward Jones, Vanguard, and other retirement planning experts consistently point in the same direction. You want balance across all three account types. A commonly cited framework is something like 1/3 in tax-deferred, 1/3 in Roth, and 1/3 in taxable accounts. This isn't a rigid rule, it's just a guide, and not everyone has the same needs or options. My point is, it can be advantageous to avoid being heavily concentrated in just one type of account. So why can this work? Because it could provide retirees with some flexibility to choose where their income comes from each year, rather than letting the IRS decide that for you. So depending on your circumstances, you may want to consider filling up lower tax brackets intentionally with your traditional IRA withdrawals, using your taxable account for near-term expenses and take advantage of favorable capital gains rates. And then you can leave your Roth growing tax-free for later years or for legacy. One study from the Society of Actuaries emphasizes that tax diversification creates what they call tax buckets for retirement distributions, allowing you to respond to changing tax laws, unexpected expenses, and market volatility without being locked into one treatment. Another way to think about this, if federal tax brackets go up in the future, you'll be glad you have Roth dollars that are not subject to those higher rates. If they go down, then your traditional accounts could become more valuable as an income source. If capital gains rates stay favorable, your taxable account can continue to be a valuable income tool. By diversifying, you could be hedging against uncertainty, and in retirement, that can be advantageous depending on your resources and specific needs. Of course, one size does not fit all, and some of these strategies may not be available to some of you. But remember, you should always consult with a tax professional before implementing any of these strategies. Now, let's be real for a second. Not everyone needs to obsess over tax diversification. If your retirement savings are modest, let's say under $250,000, You might not be going to withdraw enough each year to push yourself into higher tax brackets or trigger those IRMA charges. You may want to consider focusing on sustainable withdrawal rates and have a strategy in place that is designed to help your money last as long as possible. But once your portfolio crosses into the $400,000 or $600,000 range, I think tax strategy starts to really matter. And by the time you're at 1 million or more, it becomes critical in my opinion. Let me break this down into tiers so you can see my thoughts on where you might fall. So tier 1, that's under 250,000 in traditional accounts. So at this level, typical withdrawals could be 10,000 to 12,000 a year if you're using the 4 or 5% withdrawal rule. You're unlikely to trigger IRMA unless you have other sources of income. Social Security taxation could be low, maybe even zero under certain circumstances. And retirees in this range could potentially pay lower federal income tax. Tax diversification might not move the needle much here if you don't have additional income coming in. Tier 2 is that $250,000 to $600,000 range in traditional accounts. This is where I think things can start to shift. Using the 4 or 5% withdrawal rule, withdrawals could be in the $12,000 to $30,000 range. More of your Social Security could become taxable. RMDs could put you in the 22% bracket or higher in your 70s without careful planning. Before your RMDs start, you may want to consider Roth conversions in the 10 or 12% tax bracket. I think that could be extremely valuable. Having multiple buckets here is helpful, though not yet critical in my opinion. Tier 3 is that 600,000 to 1.2 million in traditional account range. This is where I think tax diversification can become a superpower for some retirees. Your withdrawals might be $24,000 to $60,000. I mean, your RMDs alone could potentially grow past $50,000 as your portfolio grows. Now, up to 85% of your Social Security benefits might become taxable in this scenario. And those IRMA surcharges, they become a risk. And the 22% or 24% tax bracket could become more common without a strategy. I've seen tax diversification and careful planning here save tens of thousands of dollars over the course of a retirement. Tier 4 is 1.2 million to 2 million in traditional accounts. Now at this level, I believe tax planning is central to retirement planning. RMDs can grow very large, IRMA surcharges can show up unless they're properly managed, Roth conversions can save 6 figures over time. Where you pull your money from each year could begin to directly affect your lifetime tax bill. At this level of wealth accumulation, I also think that legacy and estate planning could become very tightly connected to tax strategy. Now in tier 5, that's 2 million plus in traditional accounts. This is where poor tax planning could get very expensive in my opinion. RMDs can easily exceed $80,000 or even $100,000 per year. This could push your 85% of your Social Security to become taxable income. IRMA surcharges might compound year after year. Tax inefficient withdrawals could cost hundreds of thousands of dollars over retirement. And this is where I think legacy planning can become essential in an attempt to avoid passing tax burdens on to your heirs. So what do I think you should take away from all this? Well, the way I see it, the larger your portfolio, the more tax diversification can matter. This isn't just about saving a few bucks. Strategic planning could help protect your wealth and help preserve your options. Everyone has different needs. Someone who is very wealthy may have significant medical expenses that could drain their savings. Everyone is different. These scenarios I've described are very generalized, and I always recommend consulting with a tax professional and an estate planning attorney for individual advice on these things. So now you might be thinking, okay, Sam, this all makes sense, but what if I'm already heavily weighted towards one account type? Is it too late for me? Maybe, but maybe not. If you're in your 40s, 50s, or even 60s, you may still have time to make meaningful changes. So let me walk you through some of the levers that I recommend you consider pulling to change your situation. If you're mostly traditional, I recommend slowly building some tax-free and taxable flexibility. You may consider starting by shifting some or all of your future 401k contributions from traditional to Roth, especially if you're in a lower tax bracket right now. You can consider strategic Roth conversions during low income years, Maybe that's early in retirement before you start claiming Social Security or before your RMDs kick in. You may even be able to create a scenario where you stay in a low bracket while converting just enough to stay in the 10% or 12% bracket. You may also want to consider building a taxable brokerage account. Even if it's just a couple of $100s a month, over 10 or 15 years, that small monthly contribution could help give you more flexibility. And if you don't need the immediate income Social Security can provide, you can delay taking Social Security to possibly prolong those lower income years for conversions. If you're mostly Roth, I think this is a great problem to have, but you might want some balance. I recommend you consider contributing to a traditional account if that's an option for you. If you're in a higher tax bracket, sometimes getting that deduction today makes sense if you expect to be in a lower bracket in retirement. Building a taxable bucket in the right scenarios can help provide more flexibility, and I highly recommend balancing your withdrawals in retirement and not ignoring the value of filling up those lower tax brackets with traditional withdrawals while taking advantage of the standard deduction. If you have almost nothing in taxable brokerage accounts, and I do find this common among high savers, I suggest directing new savings into a non-qualified brokerage account. Now, to make my compliance team happy, I have to point out that investing in the stock market does involve risk, including the loss of principal. But you could also consider moving excess emergency funds into taxable accounts invested into something like a high yield cash ETF or money market fund. Using that taxable account for big planned expenses could help to not constantly tap into retirement accounts. Here's a simple rule of thumb that I go by. In your 40s, you could still have time to reshape the picture. In your 50s, you might still have some runway. In general, I think these are prime Roth conversion and contribution shifting years. In your 60s, time could be getting tighter, but you may be able to make beneficial changes before your RMDs start. And even in your 70s, while your options could begin to narrow, you might still have levers like smart withdrawal sequencing and limited conversions if they're available to you. I want to make a point here. I don't think you should let perfect be the enemy of good. You need to start where you are and build from there. Look, I know I've spent a lot of time talking about taxes, but let's be honest, taxes are a big deal. But there are plenty of other reasons why having multiple account types could benefit your retirement. Having multiple buckets doesn't protect you from a bear market, but it could give you more choices about where to take withdrawals from when markets are down. Maybe you have a money market fund in your brokerage account that you can tap instead of selling depreciated stocks that are in your IRA. Those choices could reduce sequence of return risk. That's the danger of investment losses early in retirement. Combined with ongoing withdrawals, this can significantly reduce your portfolio's value because you may not have time to recover. Each account type has its own rule book. Most taxable accounts, depending on the type of investment inside, can be liquid with no age requirements. Your traditional IRAs and 401ks are generally off limits before 59 and a half unless you use an exception like the rule of 55. Now, your Roth contributions may be accessible to pull at any time, but the earnings only become tax and penalty free after age 59 and a half, and the funds have been invested for at least 5 years. So why does this matter? Because life doesn't happen around IRS ages. If your roof leaks at 63 or your car breaks down at 58, you want to have options. I've seen retirees with just one account often feel trapped and afraid to spend. But maybe when you have a brokerage account for day-to-day needs, a Roth for legacy, and a traditional accounts for intentional bracket filling, you could have a mental map. Behavioral finance research consistently shows that when people feel like they have options, they make decisions more confidently and they stick with their plan. Different types of spending could pair naturally with different accounts. Short-term needs like a car, I say that's your brokerage bucket. Long-term legacy planning, I say that's your Roth. And predictable monthly income, I say that's filling up your brackets with your traditional accounts. I think it's all about intentionality. Roth IRAs are tax-free to your heirs at the federal level, and taxable accounts get a step up in cost basis at your death, wiping out the capital gains. Now, traditional accounts can be the most painful. Your heirs must empty them within 10 years and pay taxes at their own rate. If you leave your kids a giant traditional IRA during their peak earning years, you could be setting them up for a tax headache. I don't see people retire at the exact moment all of their income sources turn on. You might retire at 60, but delay Social Security until 67 or 70. That gap, those bridge years, is where having a taxable account could become helpful if not essential. It's the only account with no age restrictions, and it allows you to fund early retirement while leaving room for Roth conversions in low income years. Each type of account interacts differently with Medicare and ACA subsidies and other means tested benefits. Large traditional withdrawals could drive up your modified adjusted gross income, which could then trigger IRMA surcharges. Large capital gains can affect ACA subsidies. Roth withdrawals don't show up in those calculations at all. I think this might be the most important one emotionally. Diversification could help you to design a plan for the retirement lifestyle that you want, not just a withdrawal plan. Maybe you want to travel more in your 60s, slow down in your 70s, and leave a legacy in your 80s. Maybe you want a once in a lifetime trip with your kids or help a child buy a home. It may be more costly to do these if all of your money is in one taxable bucket. Having multiple levers could help to give you lifestyle freedom. Again, I always recommend consulting with a tax professional before implementing any of these strategies. Okay, here's the bottom line. Tax diversification is not about chasing the perfect ratio because everyone's situation is different and even your life may be different in 10 years than it is right now. I believe it's about trying to give yourself options. And while there's no perfect mix for everyone, the clients I see who have the smoothest transitions, the lowest tax bills, and the most control over their lifestyle tend to have a balanced mix, traditional, Roth, and taxable working together. If you're watching this and realizing you're heavily weighted in just one type of account, do not panic. You might not be behind. You could just be at the starting line of implementing a more efficient strategy. If you want help building your own tax diversified retirement plan, I'd love to talk to you. Head to the link in the description to schedule a complimentary call with our team at Foundation Wealth Partners. We'll walk through your specific situation and show you exactly what's possible. If you found this video helpful, hit that like button and subscribe so you don't miss any future content. So what are your thoughts? Do you have a balanced mix or are you working towards one? I'd love to hear where you are in this process.